To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
Hello students, so the RTP for November 23 attempt is finally out. So I am today here reviewing the RTP for CA Final SFM November 23 and there is nothing new in it. Very sorry to say there is nothing new in it. I will actually show you which all questions are there in our compiler, question number by question number, and I will compare that with what is there in the RTP. If you don't know what is my compiler, please check the description. I am giving free compiler to everybody, a compiler of 520 plus questions which are there, comprising of MTP, RTP, study material, practice manual, past question papers, non-CA material, everything. Comprehensive compiler which have very little duplication, which will help you, and with both questions and answers not as per ICA, answers actually as per what you are supposed to write in exam. Step by step, very detailed manner, a compiler is available. You can check that, it is there available in description. Now coming to the RTP first. First question is from security analysis. Okay, first question is from security analysis, and this question is actually question number 4. Question number 4 in compiler. What is this question? They have given closing values and they are asking you to check whether there is the market exhibits at least a weak form of efficiency by using the t-test, where there are degrees of freedom, so on and so forth. This is question number 4 from our compiler for this particular chapter, security analysis chapter. Compiler question number 4 is question number 1 in RTP. Now coming to the next question. Security valuation. This question also is ditto. There is not even a change. Very unfortunate. This question is question number 28. Okay, 28 from compiler for security valuation chapter. And security valuation, my dear friends, has two parts, equity and debt. And this question is about preference share, conversion value, what is the conversion premium percentage. So it and what are the profits, if profits increase after 1 million, what will be the basic EPS before conversion on fully diluted basis, so on and so forth. So you check the compiler, question number 28, you will be able to get this exact same question. Then coming to number 3. Tension-free economy is currently quoted at a PE ratio of 7.5 times, retained earnings is so and so, cost of equity is so and so, anticipated growth rate is so and so. If the company's cost of capital and anticipated growth rate is so and so, calculate the market price. This is also a super simple problem. This is question number 21. This is question number 21 from security analysis, security valuation chapter. This is from the compiler. This is straight from the compiler. Please go and have a look at the compiler. Very useful piece of document. And by the way, we also have a theory compiler if you are not already aware of. Check out about the theory compiler also in the description to this video. You will find out theory compiler and formula sheet. Then portfolio management. This is also same question. This is actually, I think probably there's one small difference, one number or so. No, actually in this question there's no difference. John inherited following securities on his uncle's death. This is portfolio management. This is question number 19 from compiler. Question number 19. We have solved it in the class. I have given the solution in the compiler. Nothing fancy. Very simple question. Then number 5. Number 5. This is Ankit has a fund of rupees 10 lakhs which he wants to invest in share market with rebalancing after 15 days, so on and so forth. This question is very similar. This is not same to same question. This is similar. This is similar to question number 75 if I am not wrong. Yes. 75. Which chapter is this? This is portfolio management chapter. What is this concept that is talked about here? Here we are talking about the concept of rebalancing of a portfolio. So this is question number 75. Not exactly same, but similar question. Numbers are slightly different. Beyond that, there is nothing else. Then coming to mutual funds. Mutual funds, somebody invested 50,000 rupees in a mutual fund in at initial offer at a face value of so and so, dividend is paid, yield is so and so. Calculate the NAV on closing dates. This is equal to question number 22 in the compiler. This is question number 22. So see friends, we are everything in the RTP except one question which I will come to. Every single thing in the RTP is actually covered in our compiler 100%. There is no way we have missed. Okay. The only thing that they have asked new is this question. Derivatives chapter about perfect hedge, what is the ratio, how much should we short. This is a simple question, there is nothing much in this, I will solve this. This is the only new question and it is a very simple question. Let us finish all the others and then we will come and solve this. Then foreign exchange management, there is this question marks, franc per dollars, exchange rate, complete the missing entries and all. This is question number 18. This is question number 18. Forex mein, this is question number 18 from the compiler. You can directly have a look at it. I have given the solution beautifully. Then question number 9. Question number 9 again is Forex. You have a Dutch subsidiary which has surplus in euros. It does not need for 3 months, which will be needed at the end of that period after 91 days. What should you do? Then how much should you deposit? Where should you deposit? We have solved this as question number 34. 34 Forex compiler. Same question, huh? By the way. Same question. There is no difference. Then international financial management. International financial management, this question is similar to question number 4 and 3. This is similar. 4 and 3 of compiler. Numbers are slightly different. What numbers are different? How much does it require? What is the dividend percentage, 3 shares under each GDR, or 4 shares or 2 shares or whatever. So this is very, very similar to question numbers 4 as well as question number 3 in the compiler, where we have talked about how GDR conversion, how you should evaluate a GDR issue, what is the cost of a GDR issue. Okay, so 4 and 3 very, very similar except for the number of shares that are exchanged for each GDR. Then coming to interest rate risk management, this is also a super simple question. This is question number 5. This is question number 5 from compiler. Question number 5 of the respective chapter. Okay, please don't think that all of these are question number 1, 2, 3, 4, 1 to 522. No, each chapter I have given questions. Some chapters have 50, some chapters have 40, some chapters have 90 questions. So the question number what I am referring to here is the question number inside the chapter. Okay. You are CA Final students, I hope you don't have any confusion in that. Next, corporate valuation. BRS Inc. deals in computer and IT hardware and peripherals, expected revenue for next 8 years. So this is a very long question, okay. Solution also is slightly lengthy, not very lengthy, but slightly lengthy. This is equivalent to question number, corporate valuation, right. This is equivalent to question number 28 from compiler. Same, ditto. There is no difference. 28 of compiler. Okay, then of the respective chapter. Then M&A. This also actually the numbers are same. I think one number or so they changed here and there, but largely this is the same question. This is question number 65. This 65th question I have actually not solved in the class. This is a question which I have given only in the compiler. Okay, only in the compiler. I have not solved in my video classes because there are multiple similar questions. So I did not solve this in the class, but I actually have given the solution in the compiler. So this is very, very easily available. This entire compiler you can download, you can watch, you can go through, and please, my dear friends, one of the most important things you as students of CA Final should note. Okay, what is it that you have to note? You are supposed to solve last 4 attempts. RTP and question paper. And if you check my previous video where I made on preparation plan for CA Final SFM, I gave 4 chapters or 4 question papers which you should necessarily solve. Okay, those 4 question paper details are also available in the description. What 4 question papers you should solve. Please solve these 4 attempts RTPs and the question papers that I have highlighted. They are very, very important from your exam. Okay, a lot of people say, a lot of people repeat, but still students don't do it, which is why I am having to force myself to repeat. Okay, now this is one very important thing. RTP is very clear. Now, only question which is new is this, which is derivatives chapter, and it's a very simple question. A company is long 10 metric tons, not meters, MT means metric tons of copper at 474 per kg of spot, and intends to remain so for the ensuing quarter. So they are long, they will remain long. The standard deviation of changes of its spot and future prices are 4% and 6%. So, standard deviation of spot, standard deviation of future 4% and 6%, and long 10 MT at 474 per kg. Okay, this is kg, this is ton. How many kgs make a ton? 1000 kgs make a ton. Okay, then the standard deviation of change of its spot and future price are 4.6%, and they have a correlation coefficient of 0.75. So, correlation 0.75. Then, what is its hedge ratio? What is the amount of copper future it should short in order to achieve a perfect hedge ratio? The initial margin is 8%. See, how much should it short? We will come back. We will first go and figure out what is the hedge ratio. How much should you hedge? If you have purchased on spot, okay, how will you hedge? You will hedge by entering into a transaction in futures. Now, spot is buy, so future is short. So, you have to short. Now what have they given? They have given here 4% and 6%. These are the standard deviations, and they have also said correlation coefficients of 0.75. So let us look at the numbers. What have they said? They have said 10 metric ton copper, that is 10,000 kg, 474 per kg, spot long, standard deviation of spot is equal to 4%, standard deviation of forward is equal to 6%, correct? Not forward, future, my bad, future. Okay, and correlation is 0.75. When you see these three, what is the number that you are getting? What is it that it comes to your mind? What is there any formula that uses these three numbers that comes to your mind? Beta is equal to R standard deviation X by standard deviation Y. What is beta? The amount of change that happens in an asset versus the change that happens in the market. So we can compute using this formula, and here they are calling it as hedge ratio, correct? That is exactly what they said, right? Having correlation coefficient of 0.75, what is the hedge ratio? So you have to figure out how many futures. So, and you please note, spot is this, forward future is this. The key question that will come up is, what should be numerator, what should be denominator? So whether this is X or this is X or this is Y or that is Y. See, please note, Y is market, correct? Denominator is market. Market determines what happens to a specific price. We are trying to hedge using a future. How is future price determined? Based on spot prices, correct? So if there is a change in spot price, that determines the future price, correct? No. What is the formula for a future or forward? Spot into e power RT. And again, you have dividends, adjustments, yield, convenience yield, all of that. Keep that aside. This is the formula for forward or future. So your forward rate is determined as S into e power RT. But when is the forward rate determined like that? At the initiation, that is how you determine it. But if you actually see in the real markets, what happens is futures prices determine spot. It sounds weird, right? What happens is futures market has more liquidity. Spot market has lesser liquidity. Why? Because in spot market you have to necessarily, unless you do day trading, you have to settle in T+1, T+2, whatever it is. Whereas in futures market, you need not settle immediately. You know, if you have a future, you will have daily MTM, but then you need not do a full settlement. You need not do the settlement for full value. Whereas in case of spot market, you will do full. So what happens typically in market is futures market have more liquidity. So because they have more liquidity, direction of the markets is more evident from futures than from spot. Futures determine this price. So when futures determine the price, then what is the formula? Hedge ratio, or what I explained to you as formula beta, as is rho, or you can call it as R, into standard deviation of spot by standard deviation of the future. Why am I saying that? The market is determined by the futures prices. Now, not only that, there is this formula where when you are trying to hedge the spot transaction using future, the hedge ratio is arrived at this. Now, based on this, what is hedge ratio? What is rho? 0.75 into standard deviation of spot is 4% by 6%. That is 0.75 into 4 by 6 is 2 by 3, that is 0.67, correct? So that will be 0.75 into 2 by 3, which is 0.5. So hedge ratio is 0.5. What does this 0.5 mean? You have to, if you have to hedge your entire spot portfolio, you have to multiply spot portfolio, number of contracts of spot that you have, into 0.5. Why into 0.5? Because your variation, if the market moves by 1, you move by 0.5. So for whatever market is there, if market moves up by 10, then you move by 5, right? So if you have to enter into contracts for market, you cannot enter into full contracts of the hedging instrument. You have to only enter into half contracts for the hedging instrument, so that the item that is being hedged is hedged properly. So you have currently how many contracts? Did they say anything about contracts? Is long on 10 MT of copper. So they did not give you the contract size. That is unfair. Okay, so what you should do is hedge using 10 MT into 0.5, that is equal to 5 MT of futures of copper short in order to hedge the spot exposure. So, one thing you have to note, friends, don't get confused with this 0.5. I will tell you why. So, let us say there is spot, then let us say there is something called imaginary thing called, this hedge ratio, whatever you have, right, is market, and then you have the hedging item, which is the future. If market goes up by 10, okay, my spot will go up by 0.5 into 10, which is 5, correct? Understood? If this is going to go up by 5 and I have 10 MT of contracts and I have 10 metric tons of contracts, then for same 10 metric tons, if I enter into a future contract, what will be the change in the value of future contract? Future contract is linked to the market, so it will go up by 10. So, you should not enter into full contract for 10, you should rather enter into 5 MT, so that it will go up by, for the 10 MT goes up by 10 is 100, whereas 5 MT goes up by 10, it is 50. Here also your 10 MT goes up by 5, then it will be 50, okay. 10 MT goes up by 5, it will be 50, whereas market is whatever is happening, move that is happening in the market determines the spot, and the hedging instrument, what you have here is future, you should multiply the hedging instrument into 0.5, which is the beta or which is the hedge ratio, okay. That is how you do. Now, what is the second part of the question, or rather third part of the question? What is the amount of copper future it should short in order to achieve a perfect hedge if initial margin is 8%? So, I think they are asking you what is initial margin. It is a very, again, CA Institute is not clearly asked what is the initial margin, they should ask. Initial margin is equal to 10 MT is 10,000, but whereas you are shorting how much? 5 MT, which is 5,000 MT into 8% into what is the price? Do we have any futures price? No, they have not given any futures price. So, we have to just take 474 per kg. Now, this is 5,000 not MT, yeah? See this, I also made a mistake. 5,000 kg. 5,000 kg into 8% into 474 per kg. So, you will get 5,000 into 8% into 474. So, you will have to deposit initial margin of 1,89,600 in order to do this transaction. It is a very simple one. There are two places where students will get confused. The first place is what is this hedge ratio, how do you find it? In this hedge ratio, what is numerator, what is denominator? Okay. Please remember, what you have to understand is the hedging or the item which determines the movement of your individual asset is at the denominator. The market is at the denominator. Futures price determine the spot price. In real world, futures price determines spot price and not necessarily spot price determines future price. Other place where students can actually get confused is this, where how much should I, how should I use the hedge ratio? Should I do 10 by 0.5 or 10 into 0.5? You should do 10 into 0.5, simple reason. If market moves up by, let's say 100%, my spot will move up only by 50%. So, how much of, and my spot is moving up by 50%. So, you see, I am talking about the original long. So, the long is moving up by 50% for a market which is moving up by 100%. So, when market is moving up by 100%, I should short something else which is linked to this market such that this goes down by 50. So, you basically short the market at 50%. In this case, market being that futures market, right? So, you short the market at 50%. So, it will be 10 into 0.5, not 10 divided by 0.5. So, if you have 10 spot contracts, you will do only half of that as futures contract for shorting. Okay. Once you have done all of that, rest of it is easy. Okay. So, this is the RTP, very, very simple. There is nothing complicated. All questions have solved in compiler. Please have a look at it and please study well. All the very best.